You've always got to pay attention to cycles in markets for sure, but you also got to think about the long-term trend. Now, monetary inflation hedges in a world where we're likely to get monetary inflation, a lot more of it, for the reasons that I've already suggested, has clearly got to be part of your investment outlook. You don't need to have 100% in gold. You need to have 100% in Bitcoin, but you need to have both those assets. And you probably need to have a decent amount in crypto because that is the best monetary inflation hedge according to recent history. It's 4 times better than gold or silver. So that's what I would be thinking about. And buy it on weakness. No one's ever going to get the bottom. Clearly, it's dangerous, as they always say, to catch a falling knife. But once you start to see some stabilization, it's worth going back in.
The biggest mistake in crypto isn't buying the wrong coin. It's watching the wrong signal. While millions of investors spend every day obsessing over ETF flows, Federal Reserve meetings, on-chain metrics, exchange balances, whale wallets, and endless social media predictions, one force has quietly dictated almost every major move in Bitcoin and the broader crypto market. It's invisible to most retail investors, ignored by countless influencers, and yet it may explain why this cycle has felt so frustratingly different from the explosive rallies many expected. Liquidity hasn't simply influenced the market, it has been setting the rules of the game. That's exactly why Michael Howell believes so many investors have misunderstood what's happening. Instead of asking whether Bitcoin is broken or whether this cycle has somehow changed forever, he argues we're asking the wrong question. According to Howell, crypto has been reacting to the same monetary forces that have driven every major asset class for decades. The real story isn't fear, greed, or hype, it's the availability of money itself. And if his analysis is correct, the difficult environment we've lived through may actually be laying the groundwork for the next major move. In today's video, Howell explains why global liquidity has become the single most important variable for understanding crypto, why Bitcoin remains one of the strongest long-term monetary inflation hedges despite painful corrections, and why investors should pay less attention to headlines and more attention to the monetary tide that's moving underneath every market. His conclusions aren't based on optimism, they're based on decades of liquidity research. If you enjoy research-driven macro analysis that goes beyond the daily headlines, make sure to like this video, subscribe, turn on post notifications so you never miss an update, and let us know in the comments, do you think liquidity matters more than news when it comes to Bitcoin?
This is looking at weekly changes. It looks a very busy chart, but this looks at weekly changes, 6-week changes, in fact, in global liquidity, which is the GLI dollar side, and BES, which is Bitcoin, Ethereum, Solana, in a 60%, 30%, 10% weighting. So that gives some broad measure, imperfect but broad measure, approximately right measure of the crypto universe. And what that's showing is the 6-week changes compared. And what I've done is to advance the global liquidity line, the black line, forward by 13 weeks, i.e. 3 months, to show that it's a predictive indicator. And what that shows is that the tracking is remarkably good. It's good until it isn't, of course, but it's been not a bad steer so far. And what that indicates is that the two assets are moved very closely together. Now, if you look at the sensitivity of that basket, the BES basket to liquidity, in comparison, the sensitivity of gold would be about 2 times, gold and silver, let's say, on average, about 2 times. In other words, every 10% increase in liquidity means something like a 20% increase in precious metal prices. In the case of these assets, crypto, it's about 8 times. So what you find is that for every 10% move in liquidity, you get 80% move in cryptocurrencies. And that's what history has shown. That's been remarkably stable. So it isn't just a sort of sudden experience. It's been remarkably stable over time, as we show in that report. And the key thing is, if that is sustained, assuming it is, you need very little crypto in a portfolio to give you pretty comprehensive coverage or protection against monetary inflation. You only maybe as at most 5% of a portfolio in crypto, and that gives you a pretty good insurance policy. And 5% is probably something that people are prepared to risk anyway. But there could be quite a lot of upside if you get a monetary inflation boom, which I think is inevitable, given the fact that governments are basically have run out of money. All they've got to do, they can only print it, and they can print money. If you're comparing, dollars with yen or dollars with Swiss francs or dollars with pound sterling, you don't want to see that move particularly. But if you start looking at the dollars against things like gold or commodities or hard assets, you'll see it immediately. But the best hedge is going to be, from experience, is going to be cryptocurrencies. That's what the data says.
Can you walk me through this? You wrote today, the R squared exceeds 32%, implying that almost 1/3 of the variation in the crypto basket can be linked directly to changes in global liquidity. And so,
so that's what this data is showing. And what it says is, in statistics, you can clearly never prove causation. You prove correlation, or you can establish correlation. We've tried to prove causation through another mechanism which is a wonkish idea, but it's called Granger causality testing, which is showing whether you get consistent leads in the data from a shock to liquidity, whether it passes through into crypto. And the answer is it does. But the R squared is more a test of correlation or association. And the way to read an R squared figure, and that's just the R correlation coefficient squared, is to say that gives you an idea of the extent of the variation in the data that is explained by the other variable. So if you've got an R squared of 50%, 50% of the variation would be joint variation between those two factors. So you've got commonality, if you like. And what this is saying is a 30% or so R squared is saying there's a common factor which you can associate, which is driving those two factors, those two variables. And so it looks as if global liquidity is a key driver, consistently key driver of crypto. Now, although people may pick me up and say, well, of course, 30% is not 100%, and I fully take that. Anything that in financial markets, anything beyond about 5 to 10% is considered to be extremely, extremely powerful. You can make money out of that consistently.
That's good. Well, do you have any inclination of what the other drivers are? Outside of just natural adoption, or?
Yeah, we did an analysis some time ago of actually looking at what goes on. And broadly speaking, the other important factors, if you broke down the degree of variation in these things, the other factors were risk appetite, and we proxied that by looking at something like NASDAQ to say that if there's a euphoria towards tech or whatever it may be, you can find that will influence crypto. And the other factor, the other two factors, in fact, were both associated with gold and precious metals. And what they basically said was that if you get, and this is a sort of mathematical result, but he said there's like an error feedback system with gold. And what it basically means that is in the long term, gold and Bitcoin and other crypto are correlated very strongly. So in other words, they both trend together. But in the short term, they're negatively correlated. So it means that they trend together, but they cycle apart. So those are the other factors that come into it. So you've got, if you like, 4 factors in that cocktail. You've got global liquidity, which is the dominant part, that accounts for about 45% or thereabouts of that total variation, or that pie chart, if you like, of the variation. Then you've got gold in the short term, the anti-cyclical effect. Then you've got gold in the long term, and then you've got risk appetite effects. So those are the 4 factors that we found were dominant in the case of crypto.
Howell's point isn't that liquidity explains every single price movement. Markets are far too complex for that. But his research suggests something far more useful for investors. Liquidity consistently provides the dominant backdrop against which almost everything else happens. Adoption, regulation, etc. demand, technological breakthroughs, and investor psychology all matter, but they tend to amplify or suppress trends that liquidity has already set in motion. In other words, liquidity creates the environment, while everything else determines how markets behave within it. That naturally raises the next question. If liquidity really is the primary driver, what happens once today's tightening conditions finally begin to reverse? Howell believes the answer lies in a much larger monetary problem that governments around the world can no longer avoid. As debt continues to expand and policymakers increasingly rely on monetary inflation to manage it, he argues that Bitcoin's next major opportunity may not be driven by hype at all, but by the unavoidable consequences of the global financial system itself.
There's no alternative but monetary inflation. And, at the end of the day, one can be cynical and say, look, if you're a politician, would you accept a future regime where you've got, let's say, 100 to 200 percentage points faster Main Street inflation? You probably would. You could disguise that in various ways, or you could dumb it down in terms of your rhetoric and try and pretend, extend and pretend and whatever, and say it's around 2 to 3 or whatever they come out with. But in reality, it's a tad more. And I think that's the reality we've all experienced over the last 5 years, that inflation simply ain't the 2% that the Fed has been targeting. It's higher than that. It's probably appreciably higher. But what that means is that if Main Street inflation is running at, let's say, 4 to 5, monetary inflation or asset price inflation is running at a figure which is another 200 to 300 basis points higher, maybe 7 to 8% per annum. And after all, that's the likely growth rate path of US federal debt. Now, US federal debt has been a great proxy for the gold price over the last 25 years. So if you looked at what the debt load has done, the debt load is up, whatever it may be, 12 times over that period, over the last 25 years. The gold price is up a similar amount, if not a tad more, and Bitcoin is up considerably more. Now, what I'm trying to say here is that the trend, you've always got to pay attention to cycles in markets for sure, but you also got to think about the long-term trend, particularly if you're a younger generation. You've got to think about this, and you need ways of protecting your wealth. Now, monetary inflation hedges, in a world where we're likely to get monetary inflation, a lot more of it, for the reasons that I've already suggested, has clearly got to be part of your investment outlook. And you don't need to have 100% in gold. You don't need to have 100% in Bitcoin, but you need to have both those assets. And you probably need to have a decent amount in crypto, because that is the best monetary inflation hedge, according to recent history. It's 4 times better than gold or silver. So that's what I would be thinking about. And buy it on weakness. No one's ever going to get the bottom. Clearly, it's dangerous, as they always say, to catch a falling knife. But once you start to see some stabilization, it's worth going back in.
Last question. Do you think when we hit 40 trillion in national debt here in the United States, do you think that level has a psychological trigger that sends people, or do you think it's just another number that we hit and nobody really cares?
I think it's another number, and what it means is we're going to get to 50 trillion in a shorter space of time. That's the reality. The fact is that there's no way to curtail debt unless there's a radical overhaul of government. And that's simply not going to happen, because we're in an era where we need big states for the reasons that I've said. Capital wars are there, and you need an active state. China has an active state, and others are copying that same model in many ways. Call that sort of a state-led capitalist system. I don't know, whatever you label it, but it's a reality. It means the state's got to be bigger and more active. It's got to take bigger stakes in industries. It's got to have its fingers in many more pies. It's got to direct trade. It's got to encourage investment, et cetera, et cetera. And at the same time, it's got to pay the welfare bills and the interest bills and the defense bills. And that's going to take either more taxation, more debt issuance, or more money printing. And you choose. And my view is that the path of least resistance to our politicians is printing more money. And they can do that either directly, or they can do it subtly. And they do it subtly by issuing lots of short-dated bills, lots of treasury bills. And that's exactly what they're doing. So bear in mind that 80% of US gross issuance now is under 2 years duration maturity. And, it was, I think, 3 to 4 years ago that Stanley Druckenmiller, in one of his speeches, said, this is crazy. These are the numbers that you would apply normally to a Latin American economy. And here they are in the US. Well, that was, 4 or 5 years ago. We're now, even more so. And in actual fact, the paradox is that some of the Latin American economies have actually cleaned their act up. So the US is going out alone, but the US is dragging everyone else with it. So Japan is doing the same. Germany's doing the same. France is doing the same. Britain's doing the same. They're just a step behind. But this is the new reality.
Michael Howell's framework doesn't promise that Bitcoin will rise in a straight line, nor does it encourage investors to ignore volatility. In fact, his entire argument acknowledges that cycles matter, corrections happen, liquidity contracts, risk assets suffer. But beneath those short-term fluctuations lies a much larger trend, one driven by the relentless expansion of global debt and the monetary policies required to sustain it. That perspective also helps explain why this cycle has felt so confusing. Many investors expected previous halving patterns to repeat almost perfectly, yet macroeconomic conditions have repeatedly interrupted those expectations. Howell's research suggests the better question isn't whether this cycle has broken history, but whether liquidity simply hasn't been supportive enough yet. If that eventually changes, history suggests digital assets could once again respond with outsized moves. Perhaps the most important takeaway is that Bitcoin shouldn't be viewed in isolation. According to Howell, it belongs within a broader portfolio of monetary inflation hedges alongside assets like gold. The distinction is that crypto has historically demonstrated far greater sensitivity to expanding liquidity, meaning relatively small allocations have the potential to provide disproportionately large exposure if monetary inflation accelerates over the coming years. Whether investors ultimately agree with that conclusion or not, it's a framework grounded in macroeconomics rather than emotion. Markets will always be noisy, headlines will continue to shift by the hour, predictions will come and go, and sentiment will swing between euphoria and panic. But if Howell is right, the investors with the greatest advantage may be those who spend less time reacting to the daily narrative and more time understanding the monetary forces quietly shaping the entire financial system. If you enjoyed this breakdown, don't forget to like the video, subscribe for more in-depth macro and crypto analysis. Share this video with anyone trying to understand what's really driving Bitcoin, and turn on post notifications so you never miss future updates. Thanks for watching, and as always, we'll see you in the next video.